All right, Jeff, welcome. Thank you for being with us today. We're we give this maybe about 2 minutes here and allow all the participants to come into the room, and we'll go ahead and get started. And so, but Jeff, you're looking good over there. Thank you for being with us today.
Great. No, thank you for having me, Gary. And I'm looking forward to this presentation.
It should be good. I mean, cost segregation is definitely an important concept for for real estate, especially for investments. And so this should be exciting for a lot of us. So thank you for doing this for us.
Yeah, absolutely. And I'm going to be doing like a 10,000-foot overview of it. So if anyone doesn't have any cost seg experience, we'll get you up to speed and in understanding some of the basic takeaways as well as some nuanced cases and things like that.
Great, wonderful. All right, so why don't we look at the time here? Why don't we just go ahead and get started? I have a little opening here that I'm going to walk us through. Then we'll go ahead and give you the show. And so, first of all, just want to thank everyone, all our attendees, for participating in our SoCal CCIM cost segregation workshop, and want to just give more information in regards to cost segregation. And so this is one of the biggest assets that we have dealing with the commercial real estate investments or any type of real estate investment. It's cost segregation. It's a wonderful opportunity that we wanted to make sure our members are aware of. We want to make sure that they have the tools that they could get out there and provide their clients the best information that they possibly can to help grow their business. And so, so Jeff, thank you so much for being here with us. And so, mission statement for CCIM, and just want to share this and remind everyone, the mission of CCIM Institute is to elevate our members to the highest levels of success in the commercial real estate profession. And that's what we're trying to do every time we're having these types of workshops, and making sure that we're giving relevant information to all our members and all of those involved in the commercial real estate industry. Also want to encourage everyone to follow us on the social media sites, on Instagram, Facebook, Twitter, along with YouTube. And I think YouTube is certainly an important one, because that's an area where everyone's going to go back and be able to see this recording along with all the other recordings that we've done throughout the year. And so thank you everyone for your support on that, on putting that together. Also want to give recognition to our board of directors. There's no way we could do the things that we do without the support that we get from the board. And so definitely want to thank you all so much, because you certainly make my job a lot easier. So thank you, everyone. Also want to give a big thank you to all of our sponsors. And I've had an opportunity to work with all of our sponsors. I could tell you that all of them are phenomenal. I'm just going to go ahead and read them off, starting from the bottom. Fidelity Bancorp Funding, Digsy, Asheville Associates, Asset Preservation, Baker Law Group, Coast to Coast Escrow Services, Platinum Wealth Group, CoStar LoopNet, AIR CRE, and our platinum sponsor, Small Business Finance. And again, want to thank all of our sponsors, for all your support. And we always want to encourage everyone that has any questions, please reach out to our sponsors. All of them are open for business, and would love to hear from you. And so, again, thank you so much for our sponsors, and we want to be able to support you just as much as you're supporting our chapter. Also want to make everyone aware, it's that time of the year again, where it's now time to renew your SoCal CCIM membership. And so, so there's two memberships. One is at the institute level, and the other is at the chapter level. And so what we're talking about specifically, at least on this slide, is at the chapter level. And this is really important for us, because, well, what we're doing and what we're offering is we are offering at $99, for the rest of 2020 and for the full 2021. Typically, a membership is between $150 to $175. And so we want to make sure that we're, again, just giving some value to those that are supporting us, and we want to support you with this value. So one thing to be mindful of is that we're only doing this until November 13th. And so this is very important, because after November 13th, the typical pricing that we talked about is going to kick back into 150 to 175, depending if you are a CCIM member or affiliate. And so just want to make sure that everyone that's on this call take advantage of this time, because after this time, it's going to go back to the typical costs. And so, if you visit our SoCalCCIM.com website, that's the area where you'll be able to find where to sign up for membership or renew your membership. And again, please take advantage, because after November 13th, it's gonna go up. So with that, cost segregation, this is a very important concept for us commercial real estate professionals. I know our company purchased a property last year, and we did a cost seg study, and I was amazed on the tax savings that cost segregation has. And so it's always wonderful to go through this and be reminded of the different opportunities that are out there, because it's not something that we deal with day in and day out as a commercial real estate broker. And it's always good to get a refresher on this. And so what we did is we asked Mr. Jeffrey Gann in Centex to join us today to give us more information on how we can take advantage of cost segregation and anything else that's new out there. And so with that, Jeff, why don't you go ahead and take it away? And again, thank you for joining us. And I'm going to stop sharing, and you're going to go ahead and share your screen. And just for everyone that's attending, if you have any questions, you have the Q&A box that you could go ahead and put your questions in. Or if you want to ask your question live, go ahead and raise your hand, and we'll bring you in at the appropriate time. And so with that, we also have a little poll. We'll go ahead and just get started here. Let me launch the poll. And the question is, have you ever went through a cost segregation study? These are for all our attendees. So yes, many of them, yes, one or two. No, you haven't, but you're interested. And so we want to hear from you. And so we make sure that we give Jeff accurate information so he knows where to spend majority of his time on the presentation. So, all right, let me go ahead and close this out in 3 seconds. And 1, 2, 3. All right, so there we go. Yes, we've done 1 or 2, but majority of the folks on this call has not done a cost seg study, but they are interested. So there you are, Jeff. All right, thank you. Go ahead, it's all yours.
Okay, well, thanks, Gary, and thanks again for everyone for joining this. I'll do my best to convey what cost segregation is, and hopefully this will be a great learning experience for everyone. As Gary mentioned, I love an interactive chat, so a conversation style presentation is what I enjoy the most. So definitely get those questions rolling. You know, if we need to move forward with the presentation, that's fine too, but I love answering questions. So if you think of something and you want to just ask it, go ahead and raise your hand or put it in the Q&A section. All right, so cost segregation. Before we get into that topic, I want to tell you a little bit about my company, Incentax. So you can think of us as a one-stop shop for tax credits and deductions. We uncover a lot of little programs that you and your clients can benefit from. Our major service lines are cost segregation and the research and development tax credit. There are some other ones that we specialize in on the screen as well, but cost seg is my specialty, and then my partner, Nojan, he deals with the R&D tax credit studies. A little bit about myself. I'm a director at Incentax. I'm also a certified cost seg professional, which is sort of the highest accolade in the industry. There's only about 50 CCSPs in the country. I started doing cost segs, in the mid to early 2000s, graduate from SC, and my industry experience is in engineering and the construction and the real estate industries, specifically on the real estate side, like the home builder side. But that was a while ago. Now I focus on cost seg. So upon completing this course or presentation, I'll hopefully have you able to explain what cost seg is and how your clients or taxpayers can benefit from it. We'll talk about some applicable real estate transactions. Spoiler alert, mostly all real estate transactions qualify for a cost seg study. There are some exceptions, and we'll go over those, but in large parts, residential investment properties like single family rental homes, as well as commercial properties generally qualify. And we'll talk about a secondary benefit of cost segregation studies that often gets overlooked, which is asset retirement studies. Okay, laying the groundwork for cost segregation. What we know about the government and taxes is that the government likes to incentivize its people, citizens, us, to do certain types of actions. And the government, they have their levers, right? They have their buttons and switches that they can pull so that citizens can do sort of as they want their citizens to behave. In the tax world and the real estate investment community, that lever is called depreciation. So depreciation basically allows an owner or a taxpayer to recover the costs of an asset, in our case, usually a property or building, over time. So as a building is purchased and used for income generation, let's say we purchased this luxury home that we're renting out, as time goes on, physically the building deteriorates, right? The carpets get worn, you know, the plumbing is used and all of that stuff, and it deteriorates over time. The government allows us a benefit of using this asset as a vehicle for income generation through depreciation. And so in a residential rental property, an asset like this depreciates over 27.5 years. Commercial properties depreciate over 39 years. So there's a little bit of a difference there. In this example here, we'll say that this luxury home was purchased back in 2017. The current year, of course, is 2020. And so when we purchased this asset back in 2017, let's say that we bought it for $4 million. Now, a portion of every purchase involving real estate generally always has land value associated with it. So just to make the math easy, let's say that the land value is 1.25 million, right? So we have a $2.7 million asset that's depreciating over 27 years. What that basically means is you're going to get a depreciation deduction even before a cost seg study even comes into mind. This is just a natural benefit that the government allows us. You're going to get $100,000 starting in 2017 from when you purchase that property, all the way down to 2045 when you fully depreciated that asset on the books. Now in real life, you know, you're going to be maintaining the asset, so hopefully it doesn't look like the picture on the right, but every year after the year of purchase, you're going to get a deduction, one slice of 27.5 years. And so let's just jump into accounting 101, because this forms the backbone of cost seg studies. So what is a deduction, right? Let's say that our taxable income, it was a pretty good year and we made $120,000 this year. If we bought that asset back in 2017, we're getting that $100,000 deduction. So our taxable income then is that difference. So instead of being taxed on $120,000 in 2020, we're only taxed on $20,000. So let's just say you're taxed 1/3 of that. So instead of paying $40,000 in taxes, now maybe you're paying $6,500 in taxes. So deductions are good, right? Because they allow us to get taxed less. And if it reduces our income down to zero and we have extra deductions, let's say that our deductions from doing a cost seg study is like $400,000, then those extra deductions roll over to the next year forever until you use it. So let's say we did a cost seg study on that luxury building. Really, if we didn't have a cost seg study done, the building would look like the image to the left. So you would have a 27.5-year asset depreciating over 27 years. With the cost seg study, we're identifying shorter life assets in that property. So in the 5-year category, let's say that we found $500,000. In the 15-year category, which is usually your land improvements. Let's say that we found $165,000. And then again, the majority of costs will largely remain in what's called real property. So 27.5-year property will still have about $2.1 million. What are the additional deductions based on our purchase in 2017? If we did a cost seg study this year in 2020, we would be looking at a $365,000 deduction that reduces our income by that much. And so the net present value of a cost seg study, what it's worth today to us, is about $103,000. And of course, there is a fee for cost seg studies, but it's nowhere close to that $103,000 value that you're getting. So how does shortening these tax life assets actually benefit us? Okay, so let's say that in our $4 million property, we did a cost seg study and we identified that there's about $50,000 worth of carpet, right? So nice carpet there. If we've never done a cost segregation study at all, then that $50,000 depreciating over 27 years would essentially mean an $1,800 deduction every year for 27 years. However, now that we've assigned the proper tax life, a shortened 5-year tax life to that carpet, we're basically recovering that $50,000 over 5 years, which is $10,000 deduction a year for 5 years. So that's how cost seg works. By compressing the time that you recover in assets value, you get a larger deduction. So a question, is the recapture rate expected to change? A lot of changes in the tax world coming up, especially with possibly a new administration. So we have to keep our eyes to it. That's a good question, and that's a question I'm looking forward to too. So keep these questions coming. I don't know is the long and short of that. Okay, another question. How does the recapture tax relate to an asset sale 2 years after a cost seg study? Okay, great question. So there's two main reasons that I would not recommend having a cost seg study done. The first one is if you plan to sell that asset within 3 to 5 years of having a cost segregation study done, because as Steve is inferring, there's something that's called recapture tax. And so what recapture tax does is you're basically taxed upon all of the shorter life assets at your ordinary rates. So you're basically, in a way, you're giving up those same gains that you got from the cost seg study. However, I've had certain clients where they know that they're going to sell the property down like in the short term, and they implement a cost seg study because they need the savings now. And even though they will deal with the recapture in a couple of years, they're fine with it. But I largely would recommend not having a cost seg study done if you have plans on flipping the property within the short term. Are the costs based on installation costs or cost index? So costs, the IRS has approved methods in determining the costs of certain assets. So when we go in there and assign like the value of a carpet, the cost per square foot of a carpet is used by an index. So we use the construction cost index of RS Means or Marshall and Swift. Those are the main two construction cost directories that we look up. Which building type will benefit most from cost seg studies? That's a great question. I have a slide on that, so we'll get to that. Okay, so in identifying shorter life assets, your 5-year and your 15-year assets, what are they? So your 5-year assets are usually known as tangible personal property, or in tax lingo, that's called Section 1245 property. In the picture here that you see, we're looking at a coffee store. And so in a retail restaurant coffee place, Some personal property examples would be like equipment, like your appliances. It would be your cabinetry, the shelving that you see on the right side. It could include your decorative lighting, your certain flooring in there, security cameras that you see on the upper left. So prep sinks in the back, and then maybe some fiberglass reinforced paneling, FRP paneling in the kitchen areas. So when you think of a cost segregation study, this is like the easiest way to think about it is when you're looking at a building, there are certain components to a building that are for the basic necessities, core function of that building. Like, what does a building need to function? It needs doors, windows, maybe elevators, ceilings, stairs if needed. And so a cost segregation study separates all of the essential components of a building, like doors and windows, from all of the extra stuff that you don't need from a building, like your cabinets, counters, decorative lighting. But cost segregation also goes one step further. So not only do we look at things that you can see through the naked eye, but we're actually quantifying electrical conduit wires from the lighting, from the outlets. There's some process piping, like the kitchen sink, as it has piping as it connects to the main lines, like waste and vent items. There may be some specialized HVAC if you're looking at, like an exhaust hood. And then if it's a new construction type of property, there are a lot of soft costs or indirect costs that go into building a project, as you all may know well. And so the fees that go to the architects, the GCs, overhead and profit, as well as permits and fees, those all get a prorated share of what could benefit as a shorter life property. So 15-year property is usually land improvements. So land improvements are generally those assets that you find outside of a building's footprint. So you can think of landscaping, concrete or asphalt paving. In industrial properties, could be that reinforced concrete paving where people, deliveries are made. Not everything found outside of a building's footprint qualifies as a land improvement. So again, that's where the expertise kind of comes in. And a question is asked. A client has owned a building for 15 years. Can we do a cost seg? Great question, Steve. You can have a cost segregation study done. I would say the rule of thumb is usually 10 to 15 years is the max that you can go. And I'll give you an example that's coming up soon on why, because we'll talk about how far back we can go. Okay, the example is just on this slide. Okay, so when you have a cost segregation study done, you're accelerating the depreciation deductions, right? So if you're looking at this line chart here, if you've never done a cost seg study, you're looking at the blue line. So that blue line is your straight line deduction that you're getting every year for 27 years. Right? So you're getting a $100,000 deduction every year for 27 years, back since 2015 when we purchased it. Now, if you have a cost segregation study done in like 2020 or even back in 2015, you're going to see a larger increase in deductions. So you're going to enjoy more deductions up front, but yes, that would mean that there's going to be a point in time in which you're actually taking less depreciation deductions in the future, because what cost segregation does is it's essentially giving you your future tax benefits up front in the shorter current period. So I liken it to a glass of water. Let's say that your work ritual is you go into work, or in many of our cases now, we wake up and roll out of bed. But let's say for working, you fill up a glass of water or a bottle of water every day at 8 a.m. and then you're taking an even amount of sips of that water. By 5 o'clock, you've finished your bottle of water and you've not stuck to your hydration plan, but you finished a bottle of water a day. Let's say that's been a really hot day and you're thirsty. So you fill up your bottle of water at 8, and then because it's been so hot, the AC is blowing, but you still want to hydrate, you've maybe drunk 3/4 of that bottle of water by noon, by lunchtime, right? Cost segregation is the same thing. It doesn't increase the amount of deductions a year, but it accelerates your intake of those deductions. So you're taking bigger gulps of deductions a year for the short period of time. And so while you can always go back at least to 1987, technically, every year that you don't have a cost seg study done, you're taking a certain gulp of that asset every year. So if it's a 40-year-old life asset, after 10 years, 1/4 of that asset's basis has depreciated. I always like to give complementary benefit estimates. So it takes 5 minutes for me to run a benefit analysis. And so it never hurts to check if there's a benefit. And if there isn't, I'll be the first to let you know that the benefit's quite small or whatnot. So at its core, cost segregation is a time value of money play. $1 in your pocket today is worth more than $1 in your pocket tomorrow, or more than $1 in your pocket 20 years from now. Why? Because you can invest that, right? Maybe you might lose that dollar or make a bad investment, but when you're talking about cash flow, and I know all of you real estate professionals are nodding your heads like cash flow is king, right? Because what does cash flow allow us? It gives us opportunity cost. So let's say that your kid or maybe you have a nephew or maybe a younger employee was thinking of buying a car earlier this year. So let's say that COVID hit middle of March and now we're all working from home, but your kid still wants to buy a car. So you can either spend $25,000 on a new car, this nice green Jeep that you see here, or what some kids or a lot of now millennials are doing is investing in like Robinhood, right? Robinhood trading app. So $25,000 can either buy you a new car that you might not really use in this environment now, or maybe you've invested in Tesla stock and it's quadrupled throughout this environment. So what's the opportunity cost here? That is something that you can analyze for your clients or yourself, but ultimately cost segregation gives you that choice, right? Because it's giving you the cash flow of your future tax savings and it's giving it to you now. So it's saying, if you want this $25,000 loan interest-free and you don't have to pay it back, this is due to you as long as you've held this asset, it's freeing up your capital in terms of cash flow. Okay, we'll talk about some applicable real estate transactions now. So as I mentioned before, cost seg kind of applies to almost all real estate transactions, but the main two groups that cost seg falls under, cost seg projects fall under, are acquisitions and new construction type properties. So acquisitions are existing properties that you're purchasing with a lump sum. So in my business, I see a little bit more acquisitions than new construction because people are usually buying another building from another seller. An acquisition also includes exchanged properties. So when you're doing a 1031 exchange, you're acquiring usually an existing building as well. And inherited properties are also considered acquisitions. New construction is just like it sounds. You're either building something from the raw land on up, or you're building a property, tearing down an existing building and putting up a new building there. new construction also includes renovation type projects. So if your client is a, most of us work in offices, I assume, and if your office is doing renovations to the property, putting in new carpets, updating some of the electrical, the new break room, all of that stuff, that transaction or that CapEx is an eligible type of real estate transaction that could affect or that could benefit with a cost seg study. Now, between acquisitions and new construction, the general floor of the basis or the minimum amount that would justify a cost seg study, rule of thumb, is about $400,000. So maybe just under $500,000, and you might be looking at a cost seg opportunity there. Now remember, for purchase price allocations or acquisitions, just like in our example, a lot of times a purchase includes land, and that land value is not depreciable. So if you have a client that purchased a home for $400,000 and the land was 50%, so you're looking at a $200,000 land and a $200,000 building basis, then a cost segregation study may not make sense. But again, I'm always happy to run numbers. Cost seg fees are usually a flat fee based on the amount of work that's needed. It's not based on the benefits that the cost seg will unlock. So just keep that in mind too. Okay, question here says, is the 27.5 or 39 years starting from the day owning the property regarding the age of the property? Yes, Diana. So once the asset transaction takes place and a new taxpayer is owning that asset, then you would start depreciating that asset on your books today. So regardless of if it's a building that was constructed in 1930, if you buy that building today, you pay X amount, you're going to start depreciating that building today, essentially. Basically, when you file your next tax return, you're going to tell your CPA, hey, by the way, I bought a building and I bought it back in November. And so your CPA is going to start depreciating that asset in your 2020 tax return. Okay, timing wise, so this kind of goes back to a little bit of our discussion on how far back you can go. A lot of people think of cost segregation studies as current year transactions. So they're thinking, oh, my client didn't buy any properties today, there's no cost seg studies done. But as Steve was alluding to, you can go back and do cost segregation studies. We call them retroactive or look back studies. Technically, you could go as far back as 1987 to when that asset was placed in service. But again, every year that you haven't done a cost seg study, you've depreciated a fraction of that asset. So it all depends on the basis of an asset. For example, if you have a $400,000 residential property and it's been 20 years, then 2/3 of that asset has depreciated already. But if you're looking at $300 million apartment complex and it's been 10 years, then there's a good chance that you can accelerate and still benefit from a cost seg study. Again, rule of thumb is about 10 to 15 years as far as you can go back. Good questions, guys. Keep them coming. Okay. Here is that slide I was alluding to earlier on the question of what types of properties can cost segs benefit from. So the way to think about properties, as many of you know, properties are like people or like snowflakes. Each one is different. Each one has its own set of criteria or characteristics that another ones don't share. Sometimes they could be the same, but in general, here is the listing of how properties benefit from cost seg studies. So as you can see, apartments have a pretty good bang for your buck. The bar basically denotes what percentage of the basis can be qualified as a shorter life asset. So like apartments are roughly in the 25 to 30%. So 30% of the basis can be accelerated. Auto dealerships, grocery stores, hotel chains, industrial manufacturing facilities are really good. There's medical centers, offices. And then as you see at the bottom, warehouses. So warehouses may not have the best benefit, but again, cost seg studies are priced based on the amount of work. So even though a warehouse may fall as the last type of property to benefit here the littlest, it doesn't mean that you should automatically dismiss warehouses from having a cost seg study done. Because let's just picture in our minds like a warehouse and a research laboratory. A research laboratory there shown as having the highest amount of benefits. From the outside, it could look the exact same thing, right? A warehouse and a research lab could look like your same type of industrial flex type of property where you have 4 concrete tilt-up walls, some parking, and maybe like a delivery trucking reinforcement system in the back. But when you get into the actual properties, how do they differ? Well, a warehouse might use its open area and just have pallet racks with inventory of the business to be shipped out there. Whereas a research lab inside, you might have a clean room with a lot of process piping, a lot of electrical switches and disconnect switches and junction boxes, things like that. So properties from the outside can vary, of course, a lot on the inside. And again, what does a cost seg study do? You're basically carving out all of the unneeded extras from a property, from a building, and then classifying them with a shorter tax life. So something like a research laboratory will have a lot more unneeded, like essential items in it than a warehouse property.
Hey, Jeff, I have a question regarding that. And the bottom of your slide says percentage of basis. And so if someone first buys, say, an apartment complex, is it the appraiser that determines the basis as far as the allocation of improvement versus land, or who determines that?
Yeah, no, great question. Really good question. So a lot of times it might be your CPA that determines that basis. As a cost seg professional, we stay away from determining that land and building allocation. There's been some court cases that have been negative towards a very aggressive allocation. Usually what I've seen is CPAs use the property tax history bill of what the building and improvements basis is. But as some of us know, the government isn't necessarily ruling the land to improvement basis in the taxpayer's favor. Usually it might just be a very land oriented result. So of course, the more basis that gets put into land, there's less benefit to depreciate. So from my perspective, I rely on clients and their CPAs to provide that basis. From CPAs, what I've seen is they've, done some research around the properties, or they've used the property tax history bills to do it. Or yeah, all else fails, you can commission an actual land valuation study, which would be, of course, in addition to anything else. Sometimes when you're purchasing a property, the bank may do their appraisal on their own and give you that basis as well. So there's a lot of ways to do it. I stay out of that conversation. I just deal with the remaining improvement basis, not including the land. Good question, because that does come up a lot. Okay, this slide, a collaborative process. So what this slide means is I always get the question like, hey, Jeff, why doesn't my CPA or enrolled agent or tax preparer automatically do a cost seg study for me? And the long and short of it is your CPA is mainly concerned with filing your tax return, getting everything else of your tax return done. They don't necessarily have the expertise in going to a property, taking measurements, looking at blueprints, understanding the construction cost details. So really I come in and I work with CPAs. In fact, most of my referral sources are largely from CPAs because they're usually the ones that are understanding their client's financial position. So our deliverable goes towards a CPA or your tax preparer, and we work with them on that. So that's sometimes something that pops up. Okay, so we're gonna get into some real examples. There was a $250,000 single family rental home that was purchased in 2013. Now, some of that was in, some of that is in land, but ultimately the additional deductions for the first year was about $35,000. So that was a tax savings of about $13,000. And cost seg study was probably a couple grand. And that's, one of our smaller examples, but we go all the way up until like this summer, I did an industrial property out in Vegas. And so this property had, I think, like 13 of these industrial buildings in there, each with their own set of tenants. And so in this $5.6 million industrial property, we were able to generate about $450,000 in additional depreciation. So that taxpayer saved about $175,000. The cost of the study was right around like $7,000 to, I think it might have been $8,000 or $10,000. So again, you're paying $10,000 for a study, but you're saving $175,000, right? So what's the process in cost seg studies? Well, depending on the type of project, the cost seg study would be heavily dependent on the site inspection. So in new construction properties, there's blueprints that are available typically. And so we'll do a lot of the work from the office before we actually go on site and see the real estate itself. So we'll look at costs, the general contractor's payment applications, we'll look at cost ledgers, and then we'll conduct a site inspection. Now, in acquisitions where there's likely no blueprints available because the property may be like one that was built in 1950, the site inspection takes much more of a bigger importance there. So we'll go on site, we'll actually have to make measurements and view all of the different tenants. If it's a multi-tenant property, measure the landscaping, look at all the piping, we're estimating the electrical, all of that stuff. So usually in acquisition properties, there's more work involved from a on-site perspective. And so when we do that, then we model all of the costs using those IRS approved cost references, so RS Means and Marshall Swift, and then we'll then chop up that asset into the various tax lives. So it's a process, but the cost seg study usually takes about 3 to 4 weeks from start to finish in terms of the timeline. All right, so we're going to talk about some secondary benefits of cost seg studies. So we all hopefully by now know what the main benefit is. By shortening the tax life, you're getting a bigger deduction in the short term. The secondary benefit that's often overlooked is something that's called asset retirements or dispositions. So let's say that we purchased let's use our example. We purchased a property back in 2017. Now it comes time for us to make some renovations. We just had a tenant move out. And we want to replace all of the windows. So when we replace all the windows and let's say that we put in some double pane windows there, so it isolates the noise. What we can do is in our cost seg study that we had done, all the value that was assigned to windows, let's say that it was $30,000 for all of the windows, we basically can write off the rest of that asset because we physically removed the windows, you know, we've disposed of them, and so they shouldn't be depreciating anymore. If you don't have a cost seg study done and you make renovations, you're missing out on an opportunity to dispose of or take an asset retirement on certain assets there. Okay, let's see. Who can do a cost seg study? Yeah, so any education or certifications to look into, what are the guidelines by the IRS? There, okay, great question, Charles. There are certainly guidelines that are set forth by the IRS. The IRS recommends typically an independent type of party that's doing it, so you can't necessarily do your own cost seg studies, but in the industry, there are certifications by the ASCSP, so the American Society of Cost Seg Professionals. And so you can look to, if you're looking for a cost seg study, I would say look towards a provider that has certifications in it. There are certain things that, like your accountant may be able to do cost seg light type projects. And what I mean by that is, let's say that you bought an apartment complex and you put in new carpeting on 3 of the units. Well, your accountant probably knows that that carpeting is personal property and is a 5-year life asset. So you don't need me to do a cost seg study on just that carpet that was placed in service. So sometimes if you have invoices or a breakdown of costs, an accountant could do like a light type of cost seg and allocate certain values or tax recovery periods to some of the assets. But they're not going to have the expertise to get into like your electrical, what percentage is qualified, plumbing, your HVAC. So really those are the main functions or the benefits that get carved out from having a cost seg study. It's your intangibles. Furniture, fixtures, and equipment. Most CPAs know that they can, you know, write off those types of things, but really, when you're having a cost seg study done, you're looking at something that's digging deep into that asset. Okay, so in continuing with our asset retirement disposition, let's say that we purchased an apartment complex, like a 30-unit apartment complex. Now, let's say 12 of the units were vacant, so 40% of them. So usually the fact pattern that happens in these types of properties is an investor may buy an apartment complex and they'll start renovating all of the vacant units. Well, there's 60% of the units still have tenants in them. So what usually happens is as those leases expire or as tenants move out, there'll be that opportunity for the landlords to redo those units. So redoing an entire apartment complex may take, you know, sometimes years to do. So when that happens, if a cost seg study is done, that's where asset retirements can take, you know, can have an opportunity to shine. Because let's say that we acquired this 30-unit apartment building back in 2015. Let's say that we renovated all of the vacant units with new lights. Well, our cost seg studies showed that the value of the old lights was $20,000. So we can write off the remaining amount of those lights, the $20,000, because we know that we've taken out those old lights. And so now we have a $17,000 write-off, just in addition to, the benefits that the cost seg study did. We now have a future write-off because of that cost seg study. So that's how asset retirements and dispositions work. Okay, so kind of wrapping up here. Yeah, if you have any questions, we still have a little bit more time for some questions, but there's 8 questions that you want to consider when considering a cost seg provider. Is the work being done or managed by a certified engineer? Is the provider even an engineer? Sometimes they're not. To what extent is audit support available for each engagement? Let's say that your client goes under audit by the IRS service. What sort of audit support is there, if any? For new construction projects, is the cost seg provider requesting detailed construction documents like change orders, invoices, your as-built blueprints? Was even a cost seg or a site inspection done? A lot of times, you get a low costed cost seg provider. They don't even see the property, right? They're just making up numbers. How aggressive are the benefits being quoted? What's the turnaround time? And then how's the cost of the study determined? So just to answer these from an Incentive's perspective, we have the expertise of a larger firm, but personal attention that comes from a boutique practice. I'm a certified cost seg engineer, shorter project times, constructive project models, and then we also provide audit support within each engagement, which is 16 hours. Most providers, if they provide audit support, it might only be like 4 hours or so. So you're not left holding the bag under an audit. You can feel, supported, be here. And this is my contact info. Great questions, everyone. Feel free to reach out and email me and get in touch with me if you want to explore any cost seg opportunities.
Jeff, this is really great information. Thank you so much for putting this together and for your time today. And we do have one person that has their hand up, and I'm not sure if they still have a question, but Mr. Michael Lawton, if you're there, why don't you come on in and ask your question? Michael Lawton, you there?
Can you hear me, Gary?
Yes, we hear you loud and clear.
Hey, Gary, beautiful job. Great session. Wonderful. No, I don't have any questions. We're in the midst of one right now on a 26,000 foot multi-tenant retail, just an 11-unit retail, and I know it's really going to help those owners. So I'm very thrilled about it. And Jeff was wonderful. I'm thinking of 3 other clients with buildings that will be useful, and I'm going to talk to them about Jeff and Incentivex to see if maybe we can connect these people.
Thank you, Michael. Appreciate it.
Oh, you're welcome. Very nice, very nice presentation, guys.
Thank you, Michael. Thank you for everything you do and all your support for myself and for the chapter. Thank you so much.
No, thank you. Thanks, guys.
So Jeff, Michael brought up a good point. So if we do have a client that has an interest in doing, just has some questions, have a cost seg, they just reach out to you, just give you a call and you'll give them some guidance. Is that your recommendation?
Yeah, please give me a call. We could talk it through. If you want to be armed with the numbers and the benefits ahead of time, as well as like a fee to discuss with your client. Like I said, it takes maybe 10 minutes to run a benefit analysis, and with that, you'll have all the information you need for your client to move forward with it. So there's no bait and switching or anything like that.
So I'm looking at our participants that are on the call, and I do see a good portion of us are commercial real estate brokers. And so for a commercial real estate broker, just to say an example, we have a client that is interested in possibly purchasing a property either for their business or for investment purposes. With us not being, the professionals of, cost seg, what are some things that we could at least bring up or we can mention to our clients that will at least kind of get them thinking that, hey, there's some additional tax incentives that are available here, if they're to purchase the property. And I'm thinking, especially some of those buyers that are on the fence, because they're concerned about cash flow. And what are some things that we could say to at least get them to the next step, to at least maybe give you a call or to kind of tickle their ear a little bit as far as the opportunities with cost seg?
Right. Good question, Gary. So one thing that could come up if a client is potentially looking at purchasing a property is, because they'll probably want some cash flow with that purchase, cost segregation study can reduce their quarterly tax payments in the current year. So even though, let's say that you buy an asset in 2020, you may have to pay your quarterly tax payments, in a week or two. And if you have a cost seg study done, you might be able to lower your forecasted tax payments because you're going to buy that property. As commercial real estate owners, as you guys are on the front lines and seeing these transactions, I also do want to bring up that, Incent Tax does, we have like a partner program where if you refer into us, that's something, a referral fee or a reduction of our fee to your client can also be, is also something that we do.
Wonderful. Well, I don't see any other questions here, but for myself, Jeff, I want to thank you so much for everything that you've done here for us. This is an amazing presentation. And so, a lot of us have heard about cost seg, and I think for some of us, this might be our first time of being exposed to it. If not, it's always a good reminder to at least go through this every once in a while. And so, Jeff, we want to thank you so much, and we want to invite you back to participate in our other events as well. So all our attendees that are here, you want to thank you so much for participating also. If there are any questions, Jeff's available for any questions that you may have. And again, just want to thank you everyone for participating. Jeff, thank you so much for your time. And we'll see everybody soon. We'll see everybody next month. Okay. All right, Jeff. Thank you.
All right. Thanks everyone for having me.
Thank you. All righty. Bye-bye.